In this recording, we're going to look at the final topics in Chapter 4. We've already looked at adjusting entries for deferrals. Deferrals are when a cash transaction takes place first, and then the revenue expense is incurred later. We also have looked at adjusting journal entries for accruals. That's where the revenue expense takes place first, and then the cash is paid later. So we went through some examples. We're not going to do this practice problem. That was just if we had time, which we didn't in class. Looking a little closer at revenue expenses. What is revenue? Well, if we go back in our notes, we have that defined. Revenue is providing goods and services. So when goods and services are delivered, we earn revenue. And then it also asks on that page, what are expenses? Expenses are when we have used or consumed a cost. So if you want, you can add that there, but we've already got it in the notes. So if revenue is providing goods and services, when do these various types of businesses earn revenue? So we know that if we earn revenue, at one time or another, we're going to collect cash. So cash is collected. But we also want to see that can be different from the timing of when we actually earn our revenue. Revenue is earned. So for instance, the Kansas City Chiefs, they collect money when they sell the tickets. So ticket sales causes cash to be collected, but what do they do to actually earn the revenue? Well, right, they deliver, they play games, play football games. That's how they earn the revenue. So the game has to take place to actually earn the revenue. And so those are at two different times. Ticket sales occur first, and then the games are played. Same thing with the Kansas City Star, right? They sell subscriptions. Money comes in. So we have subscription sales for the newspaper. But how does a newspaper actually earn its revenue? What delivers the paper? And that could be a paper or a magazine. Park University, right? Students, right? You pay cash, write a check for your tuition. So your tuition payment received. So tuition is received from the student. And what does a university do? Well, we deliver courses. So right now, right, as I'm talking to you, Park University is earning its revenue from you as a student. JCPenney, well, that kind of depends, but right, they provide goods. And they may collect that cash at the time they provide the goods. They may collect that cash later, so it kind of depends. Same thing with the grocery store, right? It provides groceries or provides goods, and it's going to collect the cash at one, somewhere along the line. Usually at the point of sale is when, the grocery store collects its cash. And then down here with expenses, we could also look at, wondering, when is the cash paid versus when is the expense actually incurred? When does it actually, take place? So like rent, usually that's a monthly thing. We usually pay our rent on the first of the month, right? That's usually due the first of the month. But if it's office, when we use the office space, if we're renting that. And so that usually is at the end of the month that we actually incur the expense. So we pay it at the beginning, we use it throughout the month. So we have finally used all of the rent at the end of the month. Salaries, the expense usually takes place first. So we usually will have, workers work, so our employees work. And then we pay sometimes at the end of the month. It could be end of the week, every other week, end of the month. So the timing of that can differ. Supplies, right? We buy them first and we use them later. Utilities, we use those, right? We use our utilities, and then we get a bill and pay later when we get our bill. The building, cash is paid when we buy it, and then we use it later. Right? We use the building after it's constructed. And taxes, property, let's ignore sales tax, let's just do income taxes. That occurs over time, and we usually have to, pay those later. Like income taxes are due, for business, March 15th, but for individuals, April 15th. So the point being is that it kind of depends when we pay it and use something, when we collect it and earn it, those can be at different times. So let's kind of look at a big picture here. So here we go again, revenue for providing goods and services, and we're either going to get cash or right to receive it. So we're going to see receiving the cash and providing the service can take place at the same time. In that case, right, cash comes in, we recognize our revenue at the same time. But it's possible for us to receive the cash first, right? Cash is collected first, and then we earn the revenue. So if we provide, so at the time the cash is collected, right, we're going to increase a liability. So cash comes in, assets go up, and we owe services, so the liability goes down. And here, we're going to decrease our liability, recognize revenue, which ultimately causes retained earnings to go up. So cash occurs first, revenue takes place at another time. Here we can have cash is received after goods are delivered. So if we deliver goods first, but we don't get cash, so we debit accounts receivable, that's what we receive, and we provide services, so we credit service revenue. So we earn our revenue first, and then cash is collected later, where cash comes in, and we give up accounts receivable. So we can see the timing. At the same time, cash first, revenue later. Or the opposite, revenue can be earned first, cash collected later. So we have these three timing differences. Okay, same thing with expenses. So we want to record expenses in the period which they're incurred to generate revenues, rather than when they're actually paid. So we can see the same thing with expenses. The expense can be paid, the expense can be incurred and paid at the same time. Expenses are debited, causing retained earnings to go down. Cash is credited, causing assets to go down. So we give up cash, and we receive these expenses. Or it could be that we pay the expense in advance. So cash is given up in exchange for usually this prepaid expense, that's usually insurance or rent. So insurance or rent are the two common costs that are prepaid. So cash is given up, and we will debit either prepaid insurance or prepaid rent. So cash paid first, and then we incur the expense. Expenses reduce retained earnings, and we reduce the asset itself. So prepaid expense, again, that would be prepaid insurance or prepaid rent would be given up. And then the final timing differences is that we incur the expense, so retained earnings goes down. So maybe we have utilities. So a good example here would be like utilities. Utilities or salaries or other expenses. So we incur the utilities, we haven't paid it yet, so we create a liability. So the expense is incurred, and then we pay it later. We reduce the liability, and cash is given up in the third. Okay, so that's looking at a big picture of revenue, expenses, and the timing possibilities. Okay, last topic, closing entries. So I want to look down here. Let's say this is, accounting period. So let's say here's year 1, 2, year 3, we have these 4 accounting periods. What happens is that, if this is 0, we want to measure, all the revenues for that time period, right? And they're going to grow over time because we keep selling and selling or delivering goods. We also will have expenses, like our utilities are going to grow over time because we keep incurring more and more expenses. So we want to measure those for year 1 and 2. Now, I want to be able to start from ground 0 when I get to year 2. I want to start from ground 0 and look, for that year, what happened to revenue and expenses. In this case, it grew even bigger by the end of the year. And the same thing for year 3, maybe they go down. And et cetera, et cetera. So the point being is that I need to be able to start at ground 0 at the beginning of each accounting period. Well, the only way of doing that is to empty the revenue and expense accounts. I mean, it's just like, if I have a cup of water, sorry, that's not a very good, but if I have a cup of water and I fill it with water, right, I fill it up with water, the only way of measuring another cup is to empty it out. So if I've got a cup of water and I need to measure a second cup of water, I have to empty this cup and then I can measure a second cup. Same thing over here. The only way I can start measuring revenue and expenses all over again for year 2 is if I empty these accounts out. Okay, so let's look what we've got up here. We have balances before adjustment, and then we have balances after adjusting journal entries. So after those adjusting journal entries, and we've looked at those adjusting journal entries on Wednesday in class, right? Adjusting journal entries either impact a revenue or they impact an expense account. And also assets and liabilities, but adjusting journal entries are to fine-tune our measurement of revenues and expenses so that we have a full year, whatever the accounting period is, of revenue and expenses. We don't want 300 days of revenues and 365 days of expenses. We want a full 365 days of revenue and a full 365 days of expense. So let's look at our revenues and expenses. Like revenue, we can see, right, it grew. So we had an adjusting journal entry to increase revenue. Same thing with rent revenue, it went up. And all, salaries and wages, right, we added more to that in adjusting entry. Same thing with supplies. Nothing happened to rent, but insurance and depreciation went up. So we can see there are adjusting entries causing, let's break it off here, all these revenues and all these expense accounts to go up. So the other interesting thing is that nothing has happened. If I look at retained earnings, nothing has happened to it. Well, let's review retained earnings. We know there's usually a beginning balance in retained earnings. We know our formula for the statement of retained earnings is to increase it with profits or net income. And if we distribute those profits in the form of a dividend, it causes it to go down to arrive at our ending retained earnings. Well, right now, we haven't updated retained earnings for that. This 5,500 is really the beginning retained earnings. So we have not, right, we have not added in, right, net income from revenues and expenses. We have not subtracted out this $2,800 dividend. So currently, we do not have the correct amount at the very end of the accounting period for retained earnings. So we are going to then go through the closing process. So we're going to, after adjustment, and then we're going to add a column here after closing. So we are going to close or empty revenue and expense accounts, and then we'll have our debit credit balances. Okay, well, let's get on with it. So let's start with revenue, the 2 revenue accounts. Those accounts have credit balances. When it's all said and done, I want to empty those. Oops, sorry, I put that in the wrong place. I want to empty those, right? They have credit balances, so under credit, I want those to have 0 balances. So if I empty it, they'll go down to 0. So we're going to flip the page. If I have a credit balance and I want to bring it down to 0, then I need to debit the account. So let's go over here. This is the end of August. So we are going to debit service revenue. If I debit a revenue account, that causes it to go down. I'm going to put in its balance, $34,600. And then I also want to debit rent revenue to decrease it, $13,100. Now, I need some sort of account to take it to. So we're going to create this temporary account called income summary, and it's only used for closing. I need a credit to balance, so I'm just going to credit the account. I'm going to plug it, if you will, and make it work. And notice I'm not putting an up or down arrow because I just need a credit. And income summary doesn't have a normal balance, debit or credit. So again, I'm just kind of plugging that in to make it work. So I'm going to plug that, and let's go post that, $47,700 to income summary, August 31st. Okay, so I'm going to post that. So now, if I have these two, now I didn't do the T accounts for all the expenses, for all the revenue and expenses, but if I post those debits, then if I posted debits, these accounts now have 0 balances. So I'm bypassing setting up all the T accounts. Now let's go to all of these expense accounts. They have debit balances. We want to empty or close every one of them. So I want their balance to be a 0. 1, 2, 3, 4, 5 of them. So if these are debits, if I want to cause these debits to go down to 0, I will have to credit them. So I'm going to credit salary and wage expense all the way down. So let's go do that. 831. Leave a space for a debit, and let's start our credits. So salaries and wage expense, I'm going to credit that account. Credits cause it to go down. Its balance was $18,100. The next account expense was supplies expense. Again, I want it to go down. Let's take a peek. Supplies expense had a balance of $2,000. Let's credit it to that amount. The next one is rent expense. And I want to decrease it. Its balance is $10,800. And the next one is insurance expense. Credits cause it to go down. Insurance expense, $1,500. And then the last one, depreciation expense. And that was for $1,200. Okay, so I've got all the credits to the expense. I need to plug a debit to make all of this balance. So I'm going to add all of these numbers up, and they total $33,600. So I need a debit entry of $33,600 for that. I'm just going to plug that to this account called Income Summary, this temporary account. Okay, let's go post our debit. $33,600, August 31st. Now, I'm going to draw my line. If I take the credit minus, sorry, I didn't mean to put those dots there, but if I take the credit minus the debit, I have a credit balance of $14,100. Now, what does that balance represent? It actually is a meaningful number. Well, let's think about it. This $47,700 represents revenue, right? Those were the totals of the revenue. This $33,600 represents the total expenses. So really, in substance, what we just did is we took revenue minus expense. Well, that amount is net income. So $14,100 is net income. Now, what balance sheet account do we want to put net income into? Well, let's go back here. Remember our statement of retained earnings? We have a beginning retained earnings. Net income causes it to go up. So our third closing entry on 8/31 is going to zero out income summary, right? I want to zero it out. Final balance, I want it to be 0, so I need to debit it to get it down to 0. So I'm going to debit income summary to empty it out. It's just a temporary account. And I want to move it to retained earnings. Retained earnings goes up. Retained earnings goes up with credits. Which makes sense. We increase retained earnings for net income. So we are just now posting an increase to retained earnings for net income. Alright, so let's post that. So 8/31. So there's the debit. So I take the balance minus that debit. That gives me a 0 balance. Retained earnings is a credit. 14,100 on 8/31. Okay, we have one more closing entry. The other thing that needs to be closed to retained earnings is this dividends account. We also, where we empty out revenues and expenses, we will empty out revenues, we will empty out expenses, and we also empty out dividends. So closing entries, we zero out all 3 of those kinds of accounts. Dividends reduce retained earnings. Dividends has a debit balance, and when it's all said and done, we want it to have a 0 debit amount. Alright, if it is a debit, and we want it to have $2,800, and we want it to be a 0, we have to credit it. So I'm going to bump down here. I'm going to credit dividends. The credit causes it to go down. 2,800, and label this August 31st, and then we want to debit retained earnings. Debiting retained earnings causes it to go down. Then we have our debit, credit. Remember, credits cause that account to go up, whereas debits cause it to go down. So net income causes it to go up, whereas net income causes it to go up. Okay, let's post the 2,800. Actually, I don't have a dividend account here to post it to, but if I posted a credit to dividends, I have a debit and post a credit, it'll be 0. And then post the 2,800, so on August 31st, post the 2,800, that causes it to go down. Now let's draw our line. 5,500 plus net income. The 2,800 represents the dividend. Add these two, subtract that, and I will get 16,800. Okay? Now, I want, after I posted all of these entries, retained earnings now has a balance of 16,800. So let's go back over here. 16,800 is our balance in retained earnings. So after adjusting entries, we close out revenues and expenses and dividends, and we have a revised balance for retained earnings. Now, none of our closing entries had an impact on assets or liabilities, right? None of these affected assets or liabilities. So when I go over to after closing, cash will still be its debit of 10,900. Accounts receivable still 9,400. Supplies still 500. Prepaid insurance still 2,500. Equipment still $16,000. And then accumulated depreciation, the credit of $4,800, that did not change. Accounts payable, $5,800. Salaries and wages payable, still $1,100. Unearned rent revenue, still a credit of $800. And common stock, still a credit of $10,000. So none of those changed. The one that changed is retained earnings, and then all of these other revenues, expenses, and dividend. Let's draw our line. If I add up all those debits, I'll get a total of $39,300. If I add up all the credits, I will also get a total of $39,300. Now, all that'll be left are balance sheet accounts. Only accounts on the balance sheet go forward because those are considered permanent accounts. Permanent. So the balance sheet, the assets, liabilities, and stockholders' equity accounts are the only ones left.